Hi, I'm Jim Masturzo, CIO of Multi-Asset Strategies here at Research Affiliates. We often use our asset allocation interactive site to look at expected returns for various asset classes. That, by its very nature, is why we created the site in the first place. But with this video, we want to take a minute and talk about the fact that sometimes it makes sense to step back and let's look at economic conditions within countries as opposed to drilling into the details and looking at, asset by asset expectations. To do that, I'm going to use our country view dashboard. And when I click on our country view dashboard, we get a whole list of countries on the left, 22 developed markets, 19 emerging markets. So, 40, 41 different countries to choose from. Here we'll look at the US. This is where we defaulted to, again, to look at economic conditions within the US. At the top here, we do show the expected returns for the major markets, stocks, bonds, T-bills. It just gives a nice, easy reference for those expectations. But again, the purpose of this is let's look at the economic conditions within the US. Starting with real GDP growth, we can see the box plot here of historical real GDP growth across the US all the way back to 1948. Currently, the real GDP growth, 3.1%. We expect that to fall down to 2.3%. So about 80 basis points of reduction in real GDP growth between now and 10 years hence. That's well within the interquartile range, nowhere near the minimum, maximum, or even the fifth and 95th percentiles. Moving on from real GDP growth, we can look at inflation. Inflation's been a topic on everyone's mind for the last 24 months or so. Currently, inflation has receded from its peak at around 9% down to 3.4%. We expect that to continue to come back down closer to 2.6%. And this is on average over the next 10 years. So from that 3.4%, reducing down even below the 2.6, but on average 2.6%. Again, well within the interquartile range. We're not calling for, at least on average, anything outside or near the mins or maxes. Now, that's not to say that inflation will move linearly from 3.4 to 2.6. It's very common when we see high inflation coming down that there are peaks and valleys that happen, and lots of volatility in inflation that we saw in the 1940s and in the 1970s could very well happen again here in the 2020s. But overall, 3.4% to an on average of 2.6. Equity market capes. How do we think about equity markets? Are equity markets expensive? We've often talked about the fact that the US market is expensive. It shows up here on this CAPE chart very nicely, where the current CAPE at 32.4 is outside of even the 95th percentile. It's not quite to the max that we saw in the tech bubble, but is stretched from historical standards. Now, our expectation is a 25% reduction down to 24.5. 24.5, as you can see here, is not particularly cheap, at least with respect to history. In fact, it's above the interquartile range or the 75th percentile. So we think there are headwinds to equity markets, but it does not mean that we're calling for a complete implosion of the equity markets, not by any means. In fact, we expect them to trade, at a nice solid 24.5, call it 25 in 10 years. Switching gears quickly to the bond market with T-bills and nominal, 10-year rates. We know the curve is inverted. It's been inverted now for quite some time. Over 10 years, current rates at 5.4 as we see rate reductions occur, and we do expect those to occur over the next 10 years, most likely front-loaded, getting us down to, T-bill yields about 2.5, whereas the 10-year will remain, pretty much where it is today. So what this means is the curve we expect to go from, as inverted as it is today to a much more normal upward sloping curve with a slope of about, 140 basis points, which is pretty typical with respect to history. Just to round this out really quickly, looking at credit spreads, one of the surprises that we've seen is that in this era where we've seen the Magnificent Seven stocks do well and everything else, have some headwinds in various spots, credit spreads have remained, really tight with respect to history or close to, call it average. Currently, 70 basis points of investment grade spread, 260 basis points of high yield. High yield in particular, we see, some headwinds and some expansion in spreads. what does this mean? So that's a lot of numbers, a lot of detail. Basically, we can summarize it as, equity headwinds persist. We're starting at a very high multiple. That multiple is expected to fall. Headwinds in equity markets from that, as well as from lower growth from where we are today. Credit headwinds, as we see, spreads expand. Again, those equity market headwinds bleed into the credit market, especially with respect to high yield. Duration, basically neutral, but the slope of the yield curve to go from inverted back to a much more normal, upward sloping curve. As a comparison, I don't want to spend the entire time talking about the U.S. Let's just choose another country, and I'm going to choose Brazil, just so we can also look at an emerging market. Really interesting and a bit different than what we see with the U.S., where with respect to CAPE ratios, currently we're trading at about 11, just south of the interquartile range or the 25th percentile. We expect that 11 to go up to 12 and a half over the next 10 years. So again, a tailwind as opposed to what we saw in the U.S. Tailwinds with respect to Brazilian equities that again are starting from a really cheap point. And have opportunities to grow. Yields, yields with emerging markets. We saw emerging market countries raise rates faster than many other developed markets, and to levels that were higher. They really went quick and hard to try to combat inflation and make sure that inflation didn't run away. So with Brazil, current yields at 9.3%. We expect that to fall all the way back towards, call it 5.5. So a lot of opportunities for capital gains with respect to Brazilian rates going forward and our expectations. So these are T-bill rates from 10-year perspective, similar kind of story, 10.6 down to 7.3. So the slope, again, what is currently a relatively flat curve, expanding to 190 basis points. So again, this is just an example of another country and what's going on at a high level, not necessarily to say that you should run in and invest, with Brazil. Again, we have 30 or 40 countries here to look through. So feel free to do that.